Welcome to Wealth Pathway here. We don't listen to the noise of mainstream media. We only track the real flow of capital in the underlying code. We don't watch what the elites say. We only watch what their balance sheets are doing. Today, we're going to explore an ongoing, irreversible great migration of wealth. This is not a simple financial fluctuation, but the laws of the physical world conducting a final reckoning on digital illusions. Let's step out of mediocre narratives and directly examine the pulse of the data. The 14th of January, 2026, this day will be recorded in the annals of global financial history, not because of some technological breakthrough or political compromise, but because of an inevitable return of physical logic. When international spot silver prices touched a historic high of $93.75 per ounce, the total market cap of global silver climbed to $5.07 trillion. In that instant, silver, this metal once regarded as poor man's gold, successfully surpassed Nvidia, which represents the pinnacle of human computing power, with a market cap of $4.45 trillion that day. This is not merely a numerical leap. It symbolizes an epic-level retreat of global capital from algorithmic assets to hard atomic assets. When the whole world realized that the future of artificial intelligence cannot be built on paper valuations, but must be built on real conductivity and physical resources, silver stepped out of the shadows of the digital age and into the spotlight. This is absolutely not a bubble, but a retaliatory correction for the extreme undervaluation of physical assets over the past century. Just as the market descended into this frenetic power handover, top investment bank TD Securities staged a ritual sacrifice of the arrogant. The trading models of this top investment bank displayed astonishing fragility when confronted with physical scarcity and capital resonance. TD Securities had brazenly shorted silver earlier, attempting to use traditional cyclical correction theory to fight against the surging tide of the times. They bet that silver prices would be cut in half to $40, with their underlying logic still clinging to the old era dollar standard and smooth supply-demand curves. However, when silver prices breached the $92 stop-loss line, they not only triggered a forced liquidation, but also turned their previous bold gamble into nothing within just a few days. The scale of losses from this short position expanded by orders of magnitude compared to last year's $2,400,000. This was not merely a loss of capital, but ironclad proof that Wall Street's elite class had lost control over commodity pricing power. The contrarian moves by top institutions were not precise predictions, but rather a high-stakes gamble amplified by high leverage. They ignored a fundamental fact: you can generate infinite numbers on a computer screen, but you cannot squeeze extra silver atoms out of a mine shaft in a short period of time. We need to deeply deconstruct the underlying logic behind this physical versus digital showdown. Silver's pricing power in 2026 has completely broken away from pure precious metal attributes, fully transitioning toward a strategic resource dominated by rigid industrial demand. Data from 2026 shows that industrial demand already accounts for as high as 65% of total silver consumption. This is a tipping point, meaning fluctuations in financial attributes can no longer shake the foundation of the physical market. Among this, the photovoltaic industry contributed 15% of the consumption growth, while silver demand in the new energy vehicle sector surged 40% year over year. When you dissect a clean energy future, you'll find that silver is its irreplaceable bloodstream. Without silver paste, there is no efficient photovoltaic conversion. Without silver contacts, there is no intelligent electronic control system. At the same time, the supply side has fallen into the trap of long-termism. 80% of global silver comes from byproduct mining of copper, lead, and zinc ores. And this structure means silver production isn't directly stimulated by price, but is constrained by the mining cycles of base metals. Declining copper ore grades in Chile and Peru, coupled with global labor unrest, resulted in 2026's production capacity growing only 3%. The supply-demand gap reached as high as 95 million ounces, equivalent to approximately 2,693 tons. This physical rupture is precisely the fuel that sent short-selling institutions like TD Securities into the crematorium. The outbreak of this storm is not merely an imbalance of supply and demand, but a prelude to the collapse of the global monetary system. In January 2026, the Federal Reserve's meeting minutes revealed a near-desperate struggle. The U.S. faced a difficult trade-off between inflation and employment, with core PCE data persistently above the 2% target, while multiple influential institutions predicted that U.S. economic growth would slow to between 1.7% and 2.3%. The Fed's rate cut expectations were not only meant to save the weakening economy, but also to delay the explosion of federal debt interest payments. Rate cuts directly suppressed the real interest rate of the dollar, causing the dollar index to fall to the 100 mark. For a non-interest-bearing asset like silver. The disappearance of holding costs meant it became the best vessel for hedging against the collapse of dollar credibility. When holdings of the world's largest silver ETF hit a historic high, when retail and institutional funds surged into this narrow exit like a tide, the combined forces of the bulls had already formed an insurmountable moat. Those investment banks hoping to profit from selling pressure brought by index rebalancing clearly underestimated the inertia of capital flows and the psychological defense lines of physical holders. If we cast our gaze back through the river of history, you'll find that the short squeeze of 2026 wasn't a coincidence, but a classic replay. From 1979, when the Hunt brothers teamed up with Saudi royalty to try controlling 200 million ounces of silver through shell companies, to 2021, when WSB retail investors tried to counterkill Wall Street shorts. The silver market has always been a battleground for the brave, but unlike history, this wave in 2026 was driven by a physical run. By the end of 2025, London's circulating silver inventory had shrunk by over 50% compared to end of 2024, hitting a low of only about 22,000 tons. Meanwhile, India's Diwali triggered explosive buying of physical silver, with silver coin sales surging 35 to 40% year over year. This phenomenon sparked a global delivery crisis, with spot premiums running high. The annualized lease rate for 1 month silver once spiked to 35.87%, meaning spot supply in the market had dried up, and shorts were forced to buy and close positions at peak prices because they had no silver to deliver. This was physical reality's most brutal judgment on digital leverage. In Wealth Pathways' view, every institution's downfall leaves behind a priceless lesson for smart investors. What we're about to reveal is an open secret. Stop loss is not a cure-all. When trading against the trend, even the strictest stop loss cannot cover up the devastating risk brought by being wrong on direction. Many ordinary investors try to imitate institutions shorting from highs operations, betting on trend reversal, yet ignore that the market won't change just because you entered. The volatility intensity in 2026 will far exceed the past, with average daily fluctuations reaching 3 to 5%. Under 10 times leverage, a single minor pullback is enough to wipe you out. TD Securities exited with losses on both short positions, and a domestic investor who lost $18 million also confirmed the same tragedy. If you really want to participate in this wealth redistribution, you must build your own silver investment system rather than becoming fuel for others. For the few smart people in our channel, I am giving you 2 sets of specific practical strategies. First is target selection. You must prioritize low premium, non-leveraged physical assets or fully collateralized ETFs. Physical silver like silver coins and silver bars, although slightly inconvenient to liquidate, is your only life preserver when facing a financial tsunami, directly hedging against geopolitical and inflation risks. Meanwhile, products like the world's largest silver ETF or mainstream domestic equivalents are suitable for capturing short-term trend profits. Regardless of which one you choose, you must avoid high-leverage futures and derivatives. In the 2026 market, staying alive is more important than making big money. For position management, single asset positions must never exceed 10% of your total household assets. Silver's volatility destines it to be a double-edged sword. Heavy positions will not only destroy your finances but also your mindset. I recommend using a phased position building approach, making ladder-style additions near the key support level of $80 in 2026, while setting a hard stop-loss line of 8 to 10%. We must stay vigilant at all times about technical variables in the market. Although silver's industrial rigid demand currently looks unbreakable, high silver prices will inevitably force technological innovation. Some leading photovoltaic companies are already developing low silver or even silver-free battery technologies. If such alternative technologies accelerate their rollout, it will weaken silver's industrial floor in the long run. As an investor, you need to closely track photovoltaic installation data and the penetration rate of new energy vehicles. If demand growth slows down significantly, or if the Fed is forced to restart rate hikes due to runaway inflation, that is your ultimate signal to liquidate and exit. 2026 is a year full of opportunities, but also a year that buries the arrogant. At this juncture, every weakening of the dollar, every tightening of geopolitical tensions is fueling silver's rise. It is expected that at the end of this cycle, silver will make its final sprint toward the $100 mark. The purpose of Wealth Pathway is to help you protect your principal in crazy market conditions. You need to understand that all financial games ultimately come back to the baseline of physical supply. Wall Street can create countless sell orders with code, but they can't conjure up tens of millions of tons of ore. TD Securities' crushing defeat tells us that when you try to use numbers to challenge the gifts of the earth, the ending is already written. Don't bet on the end of a trend. Follow the scarcity of physics. This epic silver short squeeze is essentially humanity's rediscovery of the value of real wealth. Do you want to keep drowning in the illusion of digital paper money, or join this battle to defend hard assets? The answer lies in your asset allocation. At Wealth Pathway, we believe assets are destiny. In this turbulent 2026, guarding your wealth is like guarding the key to entering a new era. Don't be fooled by those so-called authoritative predictions. Look at the increasingly depleted mines and the frantically running factories. Market opportunities are never in short supply, but what is lacking is a heart that respects the laws of physics. Remember, fundamentals are king. Risk control comes first. Don't fight the trend. Don't go heavy on positions. Only this way can you stand firm in the silver market storms for the long term. Instead of becoming a sacrifice of the times. Thanks for watching. See you next time.